Good afternoon, everyone. Thank you for joining me. We'll just wait a couple of minutes to see if any further people are joining us, and we'll get started shortly. Right. Well, thank you for joining me today. I'd like to present a brief whistle-stop tour, giving an introduction to some international VAT issues. Um, Obviously, as business owners and financial professionals, you're increasingly likely to encounter VAT issues internationally, particularly as business grows and expands beyond the UK's borders. Today's session aims to give a practical understanding of VAT relating to these international transactions, looking at what triggers obligations and how to avoid costly mistakes. This isn't about making you VAT experts, but it's trying to ensure that you have a general awareness of the issues, what questions to ask, and when to seek further advice. So, today we'll be covering various aspects of this. We'll start by looking at goods and how VAT works when you're buying or selling physical products internationally. Then I'll turn to services, which have their own set of rules and complications, before I look at the administrative requirements, the paperwork and processes you need to get right. And finally, I'll turn to what it means to trade abroad more permanently. Throughout, I'll try to use some practical examples to help illustrate how the rules work, and so that we can understand this clearly. So I'll start off with a quick background. Obviously, you're all aware of VAT as being a tax on consumption charged at each stage of the supply chain. It was designed as a simple tax, but significant complexity has evolved over time. While the standard VAT rate in the UK is 20%, rates vary globally. And for example, within Europe, Denmark charges 25%, while Luxembourg charges just 17%. The key principle is that VAT should be paid where consumption occurs, but the value-added principle means that businesses have to account for VAT all along the supply chain. For each supply, we must establish which country or countries in which VAT will apply. This has become into sharper focus following Brexit. I don't want to talk too long about Brexit, but it introduced a significant change for the UK. Crucially, the UK has now become a third country for the EU for VAT purposes. This means we're not part of the European Union's single market, and as a result, from a UK angle, we're only worried about whether our transaction is involving a UK or non-UK customer. The EU is no longer a distinguishing factor for the UK, so transactions with other countries are treated in a similar way, so the EU becomes similar to the US and China as far as trading from the UK is concerned. Brexit has meant more formalities, and potentially more VAT registrations may be required. But many of the fundamental EU principles have remained, and we still use this original EU law as the backdrop to the UK's VAT rules. Despite us leaving, the EU has maintained a continuous and harmonised VAT system across its member states. So previous knowledge of how VAT worked is still relevant as far as trading within the EU. So why this matters now? Even small transactions can trigger registration requirements in other countries. We need to be concerned to make sure we're doing it right, because HMRC and the overseas tax authorities are using increasingly sophisticated methods to identify non-compliance. So sitting on our hands and hoping it won't cause a problem is not necessarily the solution here. Brexit and the UK's status as a third country has made international VAT more complex for UK businesses. We also have got some new rules to do with digital marketplaces and e-commerce that again introduce more obligations. The cost of getting it wrong can be substantial. We can have penalties based on a percentage of the tax due, and interest can accumulate daily. So we need to make sure we're getting it right. Otherwise, there might be a potential for double taxation or incurring irrecoverable VAT if we're not set up correctly. Finally, there's also the risk of reputational damage with customers and suppliers. So how do we get this right? Well, the key to this is the 3 W's. The 3 W's are who has supplied what to whom. The who part of this is, are we dealing with other businesses on a B2B basis, or is it end consumers on a B2C basis? Are they VAT registered or not, and where are they located? The next step is to be clear on what is being supplied. Is this goods or services? Are they digital? And what's the precise nature of the supply? And finally, the whom. Where is the customer located? Are they VAT registered? Are they in business? So different combinations of these factors can trigger very different VAT results. So this is the key to understanding all the VAT transactions in the UK and abroad. So let's start by looking at goods, and particularly the place of supply. The place of supply is important because it determines which country's VAT rules apply. For goods, the place of supply is generally where the goods begin their journey to the customer, and so VAT applies in the country of dispatch. This sounds simple, but it can get complex with the movement of goods. So let's have a look at a couple of examples. In the first example, we've got some machinery manufactured in the UK and held in a UK warehouse that's going to be delivered to a German customer in their factory in Germany. This will be a UK supply as the goods are dispatched from the UK. If the same situation applies but was being held with the machinery in a French warehouse, it becomes a French supply, and as a result, it's outside the scope of UK VAT. A third scenario might be where an overseas customer, in this instance a Dutch customer, collects goods from a UK warehouse. In this situation, it's a UK supply, although it might potentially be capable of being an indirect export. The critical moment is when the goods are, the ownership of the goods are transferred. In all of these examples, that's the crucial moment. The delivery terms, Incoterms usually, matter for VAT as well as for commercial purposes, because they will set the point at which ownership of the goods transfers from you as a supplier to your customer. If you retain ownership right the way through until delivery, there's a risk of moving VAT obligations abroad. So that's an important consideration. Right, so now let's look a little bit further in detail about exports. The basic rule of exports, where the dispatch happens from the UK, is that they're subject to UK VAT. But instead of the usual 20% rate, we have a 0 rate for exports. This means that it's still subject to UK VAT, but at 0%. A VAT invoice is required, but the good news is that the customer doesn't get charged UK VAT, and you can still fully recover any input tax related to those goods. For 0 rating, there are crucial evidence requirements to do with proof of export. It's necessary to obtain the paperwork to justify that this is an export, and usually that must be done within 3 months of dispatch. HMRC are very strict about these evidence requirements, and there are more details that set out exactly what's required in their Notice 703. It's important to avoid some common mistakes here. The crucial thing is not to just assume an export status without evidence being held. One good method for dealing with this is perhaps to charge UK VAT until such time as that evidence is obtained, particularly where we're talking about a scenario where the customer's collecting the goods and has to provide you with the evidence. Obviously, if all of the evidence is in your control, absolutely fine to zero rate. Another important part of this is retaining the documentation. HMRC can ask to see this at a later date, so it's important that it's retained. And treating a delivery to a UK address where we're supplying an overseas customer is not an export unless we've got evidence that the goods are actually leaving the UK. That's an important point because you may see on your invoice a supply to, say, a German company, but if the goods don't leave the UK, that's still a UK supply and would be subject to 20% VAT. Similarly, if you've got a collection from you that you know is an overseas customer that will be taking the goods abroad, evidence of the export is really important. The flip side to this is imports. Now, here we'll be looking at the imports into the UK as well as abroad. The same place of supply rules apply to imports, but when goods arrive in a new country, including the UK, there are additional VAT considerations in the form of import VAT. Import VAT applies when goods enter the UK from anywhere outside the UK. Goods entering an overseas country from the UK will also be subject to import VAT considerations. VAT is usually charged at the same rate as domestic supplies on an import, and as soon as the goods cross the border into the new country, that is usually the point at which an import VAT obligation is triggered. So understanding how this works is crucial, and this is where the importer of record concept comes in. This means that someone is responsible for the import procedures and for the payment of any import VAT, and that person is nominated on the paperwork as the importer of record. That's still the case even if you're using a freight forwarder or a courier of some sort. You may still be the importer nominated on the paperwork, even if DHL or whoever is transporting the goods on your behalf. The duties of the importer of record is to pay any import VAT as well as any customs duties. I won't go into customs duties in this webinar as that's not really my expertise, but usually we can get assistance on that from freight forwarders. They have a lot of experience in dealing with that and the paperwork that's needed to report it as goods cross into a country. The important point about this is that the importer is typically the person who has the right to dispose of the goods. In other words, who owns the goods at the point of import. From a business perspective, if you're importing, you're likely to be the importer of record. So here in the UK, if you buy goods from an overseas supplier, it's likely they will nominate you as the importer of record as far as the UK is concerned. As a result, this will mean you're responsible for the customs declarations and paying import VAT using postponed VAT accounting, potentially. It's important to consider this point in your contracts to make sure that there's no disputes or doubt over who's dealing with this. Freight forwarders will typically act as your agent and help with the paperwork. But it's important that the supplier is well aware of the arrangement so that they can deal with this. Looking at postponed VAT accounting, this is a new system or relatively new system that was introduced following Brexit. Before Brexit, imports into the UK from the EU were not subject to VAT at the border. But with the introduction of import VAT on all imported goods into the UK, it became necessary to simplify the process, and that's what postponed VAT accounting does. What happens with postponed VAT accounting is that no VAT, no import VAT is payable to HMRC, and it's dealt with on the VAT return rather than being paid at the border. This has the benefit of not outlaying the money to HMRC, and it's simply the VAT is simply declared as output tax on the VAT return, but usually with a matching input tax claim, assuming that the supplies are being used for VATable further onward supplies. This means that there's no net amount of VAT payable to HMRC. We're just simply editing the VAT return to include the value of these imports. Obviously, you must be VAT registered to use this system, and there are a few situations in which it doesn't apply, such as where goods enter customs warehouses. The practical benefits of postponed VAT accounting are that they're likely to reduce delays at the ports. They will improve cash flow as money's not being paid to HMRC and then being recovered, and it simplifies accounting where the VAT is fully recoverable. A requirement of this is that the supplier must be aware of your VAT registration, and you'll need to give them your EORI number so that they can put that on the import paperwork that the courier presents to the customs officials on arriving in the UK. As a result, it's important to notify the supplier in good time. I'll now turn to the rules around services. These rules are much more complex than for goods, and there include significant differences between business to business and business to customer supplies. As a result, you must verify if your customer's genuinely in business. Usually their VAT registration is the best evidence, but it's also important to confirm the nature of the service being supplied, as that affects the VAT treatment. So the place of supply of services has one initial overriding rule that if it's a land-related supply, then it is taxed where the land is. That's an important consideration for services such as construction and anything related to a fixed establishment, particularly where that differs from where your customer is located. There are significant differences in the remaining rules relating to the place of supply of services between B2B and B2C. For example, a business-to-business supply of marketing to a German company is taxable in Germany, not the UK, whereas a vet providing services to a French pet owner is taxable where the business belongs. So if the vet is a UK vet, that will be in the UK, irrespective of where the actual services are performed. So let's have a look at the reasons why we have these differing rules. Firstly, I'll look at B2B supplies. There's a general rule, and that is the place of supply is where the customer belongs. So for services supplied to an overseas customer, we're not in the scope of UK VAT. It will be the customer that is a country that dictates where VAT falls. This is quite straightforward, and there are some exceptions, but these are quite modest for B2B supplies. The crucial ones are events such as entertainment and cultural activity, so sporting events, music concerts, things like that. Those are treated a bit similar to land-related supplies and taxable where the land is located. And there are a couple of other use and enjoyment supplies which cover electronically supplied services and goods on hire. So use and enjoyment is where these services are supplied in another country to the one in which the supply would normally be deemed to take place. And this might bring a supply of services either into the UK's VAT net or outside of it. So, for example, if we were supplying a French customer with a service that was, say, goods on hire in the UK, that would still be subject to UK VAT, despite the customer being outside the UK. The flip side would be if we're supplying a UK customer, but they're going to use those services wholly abroad, then that would be outside the scope of UK VAT. We also have a reverse charge on purchases, which I'll cover in a little more detail later. So now let's turn to looking at the B2C supplies. The underlying presumption here is that the supplier charges VAT, but there are many exceptions that can override this. We've already mentioned that land-related supplies are taxable where the land is located, and that would mean that in some situations a B2C supply won't be subject to UK VAT if the supply relates to land abroad. Other services affected by differing rules are transport, which generally is subject to VAT where it takes place. These rules can be a little complex because journeys typically may cross borders. Then we have a rule that's similar to the land-related one, which covers cultural, artistic, sporting and entertainment events, and those are subject to VAT where they take place. We also have a specific rule to do with professional services, and these are taxable where the customer's located. This covers various legal and professional services. For example, if HWB provides accountancy services to a Spanish resident individual, that has a place of supply in Spain. So that's not subject to UK VAT, and it would be only Spanish VAT that could apply. We have rules to do with telecommunications, broadcasting, electronic services, which have a place of supply where they're consumed, which is typically the customer location. Digital services cover various things such as downloads, streaming, online advertising, that sort of thing. And those can trigger registration requirements in the country of consumption. So it's important to be aware that some of these rules that push the place of supply abroad may trigger a VAT registration obligation in that country. This can get complex. So, for example, if it was a digital supply, you can see how that might be supplied to many countries throughout Europe. Europe has a one-stop shop scheme available, which is a form of VAT return that allows you to report to one EU country all your supplies across the whole EU. It's still necessary to account for that using each country's VAT rate on this return, but it saves filing VAT returns in every single EU country in which supplies are made. So that's a useful simplification where that applies. So let's have a look now at the reverse charge on purchases. This is one for business to business situations. And in this instance, the overseas supplier won't charge local VAT. And instead, when you receive those services in the UK, you account for VAT on the VAT return. Again, this is similar to the postponed VAT accounting situation where we're accounting for both input tax and output tax. It's important, however, that invoicing reflects that this reverse charge will apply. Usually this is covered on the invoice to make it clear that it's a reverse charge supply, and therefore the invoice won't show any VAT. As a result of the accounting for both input and output tax on the VAT return, there's usually no net payment to HMRC. From your perspective as a UK business, that means selling services abroad, you're not charging VAT. The customer accounts for the reverse charge in their home country. When you're buying the services in from abroad, it's important to apply the reverse charge. The requirements to make this work are to do with invoicing, and it's important on an invoice that you make to an overseas customer that it's clear they're abroad. So that would include stating their overseas business address, and you'll need to hold evidence of the customer being in business. Ideally, you would verify the customer's EU VAT number, and there's a system within the EU to review the VAT numbers to check that they're still live. That VAT number doesn't have to be stated on the invoice, although you can do, and that's a good check though that you've proved that they're in business, and you should record that in your own records. Common errors in relation to the reverse charge on purchases are charging VAT in the UK when it should actually be a reverse charge supply of services. Similarly, not charging the reverse charge on yourself when making purchases from overseas can be an issue, and also making sure that there's sufficient record keeping. So let's turn now to look at some of the admin to do with international VAT. Firstly, we need to think about how the invoices work. We have specific requirements on invoicing to be clear as to the description of the supply. And this is something HMRC in the UK has recently been pushing back on a little bit more, where invoices have been worded with very vague wording. Fortunately, so far the courts have said no, there's no prescriptive description required, as long as it's sufficient to allow the tax authority to start their investigation into what the supply relates to. That's sufficient. It's important in international matters to make sure that the place of supply is stated on the invoice. So if we're talking about a supply of services that is not subject to UK VAT, we can state that the place of supply is where the customer's located. Ideally, the invoice would have wording such as reverse charge applies, customer to account for VAT. It must not show UK VAT has been charged. So don't submit an invoice that shows 0% VAT, where the place of supply of services is where the customer's located abroad. The invoice shouldn't mention VAT on the invoice as a separate amount. And as I've mentioned, it may be helpful to mention the customer's VAT number just as evidence that they're in business and will account for the reverse charge VAT in their home jurisdiction. Another topic that's becoming increasingly important is electronic invoicing. So this does not mean just simply posting a PDF invoice by email to a customer. This is a technical submission of electronic data between two computer systems. In the UK, we don't yet have this system, but many European countries and other jurisdictions around the world are moving to mandatory e-invoicing. It's seen as a measure to prevent avoidance, and it allows transparency for the tax authorities to monitor transactions. My understanding is that Italy, Spain, and Poland already have requirements in place. France is also introducing mandatory e-invoicing, and the rest of the EU is scheduled to complete this process by around 2030. From the UK perspective, obviously we may need to comply with overseas obligations, but here in the UK itself, we've got a current ongoing consultation regarding the introduction of electronic invoicing, and we're expecting further details as a result of this to be published in November this year, and obviously that could lead to some significant changes. From this, we now then need to think about planning. So when we're making a supply abroad, we may need to check with our customers whether they've got electronic invoicing requirements that have to be complied with, and this might entail an update to your accounting system. We also need to think about any changes in terms of the amount of time needed to make that happen. So it's important to consider this well in advance of trading abroad. The next area of admin that I'd like to just turn to is the rules surrounding non-established taxable persons. This status relates to a business that's trading in a country but is not established in that country. So that means usually there will not be a permanent establishment, such as an office or a place of business that business is carried out in that overseas jurisdiction. In this situation, the non-established taxable person, i.e. that could be your UK business, is treated differently to homegrown businesses, and often this means that VAT registration requirements will be triggered immediately upon the first sale. Sometimes there's a simplified system to deal with this matter, but there may be enhanced obligations such as payment of security deposits, and it may require a local representative on the ground in an overseas jurisdiction to deal with this in some instances. The practical implications, therefore, of this situation is that often you can't benefit from local exemptions or reliefs. It may also be necessary to submit local VAT returns abroad, and this can be quite frequent. And if this is all going to present hurdles and problems, it may be preferable to consider whether a full establishment of creating a permanent business place abroad is beneficial, and that might allow a full VAT registration and to be treated in the same way as the local VAT businesses. Obviously, this comes with higher compliance burdens, so it's not a step taken lightly. So let's look in more detail about trading abroad. This is often beneficial as you expand a business, but as a result, this means that you can end up with additional registration requirements abroad. The place of supply in an overseas business is crucial, but supplies made using a local establishment or fixed presence may benefit from a threshold before registration becomes compulsory. It's important also to note that sometimes the acquisition of goods from one EU member state, perhaps for supply on to another member state, can trigger a registration requirement, and because of the point about the place of supply. In other words, if you acquire goods in a country and then supply them to a customer in another country, you're making a supply in the country that you've acquired those goods. It therefore is important to monitor the threshold, and this has to be done by the sales in each country. The thresholds are often based on a calendar year, but not all countries use that. Some use a rolling 12 months, for example. And once exceeded, it's important to register from the first sale or from the beginning of the next tax month. Strategically, there are some considerations to make here. Sometimes it's worthwhile looking at registering before the threshold for compulsory registration is exceeded, and that might also allow you to benefit from input tax recovery on purchases made. An alternative might be to consider whether it's possible to stay below the registration thresholds if you don't want to deal with the administrative burden that it poses, but obviously that limits the value of the sales that can be undertaken. It's important to evaluate the costs and benefits of all these options, and it may be possible through a registration in one EU state to make use of simplifications such as triangulation to avoid further VAT registrations in other EU states. It may also be possible to reclaim EU VAT from other EU countries quicker if you already have an EU VAT registration, as the processes for doing the repayment claims are slightly different when VAT registered in Europe. If you're just simply registered for VAT in the UK, you may still incur VAT abroad. For example, you may visit a trade show in France and incur hotel and travel and meal expenses that incur VAT. That VAT is in connection with making a business supply, even if no supplies are made in France. Maybe you only sell from the UK, but that would still incur VAT that you could recover. There's a separate process for non-VAT registered businesses in the EU under the 13th directive. These typically require a claim to be made in the local language, and it can present difficulties because there are tight deadlines to do this, much tighter than for VAT registered businesses. Typically, you might only have 6 months from the end of the period, and it will be necessary usually to submit copies of original invoices and detailed records. As a result, this process is slower than simply submitting an overseas VAT return, and you should factor that into account when looking at cash flow matters. There are some long processing times and language barriers to overcome, but you may also need a local bank account to deal with that. So this then leads on to the point about when should you seek professional help. In general, it's a good idea to seek overseas assistance from, say, an accountant abroad if you're compulsorily or voluntarily deciding to register for VAT. Maybe you are undertaking a high value transaction that might have potential VAT implications, even if this doesn't necessarily trigger a VAT registration obligation. Also, if you've got an unusual supply chain or there are triangular transactions, seeking professional help can be a good idea. Similarly, with digital sales across multiple countries, you're likely to need some assistance to deal with that because that can be very onerous administratively. And you may also want to consider restructuring to create an international entity or two. And again, professional help would be a good idea for that. Who should you turn to? Well, HWB are part of the ETL Global Network, so we have contacts of similar independent firms throughout Europe and wider, but other networks are available. The networks are a good place to look for this help because typically they'll have English-speaking assistants that can help with this. The value of professional advice is that it allows you to navigate these complex rules correctly the first time. We're looking to avoid any penalties and interest, but also optimizing your VAT position. The overseas assistants can help with registration and compliance. They can actually deal with overseas VAT returns directly for you, so that may save some paperwork. And they can also manage any claims and disputes on your behalf. So this whistle-top store's nearly come to an end. I'd just like to recap some of the key points to what you should consider. Firstly, always ask who's supplied what to whom. With that knowledge, you're in a good place. Think about whether it's a supply of goods or services due to the different rules we've touched upon. And similarly, it's important to understand the customer. In other words, is this a B2B or a B2C supply? Get evidence and documentation to support what's happened, and think carefully about contracts. And when in doubt, seek advice early. So your action points really are to think about reviewing your current international supplies, look at your invoicing processes, and consider whether there might be some VAT implications from any contract negotiations. And also think about starting to build relationships with advisors before you need them. So all that remains now for me is to say thank you for attending. If you've got any questions, I'm sure you can pop them in the chat or contact me directly, and I'll be happy to assist further.